Yo, what up, everybody? This is your boy Sharaf again, back with Disruptive Investing channel. Today, I'm here to talk to you about the future of energy sector, where our transition from fossil fuel to renewable energy is disrupting not only the entire sector, but also the world economy at large as well. So you need to be on the right side of this transition with your investment so that you can give yourself the best opportunity to make big money. Two names that stands out in the renewable energy sector are Canadian Solar and Brookfield Renewables. In this video, we'll compare, contrast, and explore which of these two companies offer a better opportunity for investor. We will look into their financials, valuations, and the growth potential so that you can make your own informed decisions. But please do know that I'm not a financial advisor, and this is not financial advice, so please do your own research as well. And with that being said, let's just get right into it. Well, first of all, before we even get into any kind of analysis, I want to give you a brief overview of both companies so you guys can get a better sense of what they actually do. Canadian Solar is a pure solar energy play within the larger renewable energy sector. Canadian Solar organization is divided into two divisions, CSI Solar and Global Energy. CSI Solar operation is mostly limited to China, whereas their Global Energy division is spread all across the world. Moreover, CSI Solar focuses mostly on the manufacturing of solar products such as solar modules, cells, and inverters, with limited energy storage business capacity as well. Meanwhile, their global energy business is more diverse and is involved with the development of the solar power plant worldwide, which includes responsibilities such as providing engineering, providing solar modules for the plant, and also sometimes providing operations and maintenance support of the plant. Although they may seem like do-it-all solar company, but if you look a little deeper into their revenues, you can see that CSI Solar side of business, which manufactures solar modules and related products, provided almost 90% of the third quarter revenue at $1.14 billion, whereas other areas of business within Global Energy Division, including development and operation of solar power plants, only accounted for the 10% of the revenues. This means that even though Canadian Solar does operate and maintain power plants worldwide, it is still primarily a solar modules and product manufacturing company based in China. Please keep this fact in mind as this will have much greater significance in the analysis to follow. In contrast to Canadian Solar, which is mainly a manufacturing company, Brookfield Renewable, on the other hand, is an asset management company which manages and operates various renewable energy power plants and assets. They own more than $60 billion worth of renewable power plants spread across all renewable sector, including wind power, hydropower, as well as solar power plants. However, as you can see from the chart, almost 50% of their power capacity comes from the hydropower itself. In terms of the size of their businesses, if we look at the Canadian Solar main business of selling solar products, Canadian Solar so far in 2021 sold almost 17 gigawatts of solar products, including battery storage equipments and products. However, for a fair comparison of size and capacity of both companies, we need to do apples to apples comparison of power capacity of assets and power plants under operation by both companies. We can see Brookfield Renewables completely dwarfs Canadian Solar as the total power capacity of asset under them is at 2,500 megawatts or 21 gigawatt, which is almost 10 times the power capacity of asset managed and operated by Canadian Solar, which stands at mere 2.2 gigawatts. So now let's look at what does the differences in their business model and types of asset under management for both companies mean in terms of dollar value. To look into that, we will have to look at the gross revenues of both companies. For the year of 2020, the total revenue for Brookfield was $3.8 billion in comparison to the Canadian Solar revenue of $3.5 billion, whereas in the latest reporting quarter of Q3, Brookfield's revenue was around $960 million, which was up almost 10% from previous year's third quarter, versus Canadian Solar revenue of $1.2 billion, which represented year-over-year growth of 35% from Q3 2020. If you take the market cap into account, represented by the PS ratio, you can see Canadian Solar is outperforming Brookfield Renewables. As you can see from the chart, the trailing 12 months PS ratio of Canadian Solar is only 0.46, which means that you are paying only 46 cents to buy $1 of revenue, whereas the PS ratio of Brookfield Renewable is 2.31, meaning you are paying $2.31 to buy every dollar of revenue. Next, let's explore the net income of both companies and do a comparison in terms of the PE ratio. The net income for Canadian Solar in 2020 was $146 million. That is, Canadian Solar made a total of $146 million in profit from the revenue of $3.5 billion in 2020. whereas the net income for Brookfield Renewables was negative 59 million. And if you look at the latest quarter of Q3, we see the net income in Q3 for Canadian Solar was $35 million, whereas for Brookfield Renewable, their Q3 net income was negative $97 million. From this quick financial and valuation analysis, it may seem like Canadian Solar is a far superior company and Brookfield Renewable is a total garbage company. However, therein lies the trap of just simply looking at one or two financial ratios in isolation. And I actually did a video on avoiding this very trap while investing, for which there is a link in description if you want to check it out. As I said, the truth about companies' potential of financial health usually lies deeper beyond just a surface level analysis. And that is exactly what we are going to do in this section, which is to explore if Canadian Solar is indeed a much superior company for investment as suggested by its PE ratio alone. To get a better sense of Brookfield Renewable's financials, we have to look at its free cash flow. And for those who do not know the major difference between free cash flow and the net income from which the PE ratio is derived, is that the free cash flow does not include non-cash items such as amortization and depreciation, whereas the net income statement does include the amortization and depreciation values. This means that you can get free cash flow from net income statement by adding back depreciation and amortization value since those are non-cash items and then subtract any capital expenditure. So if you look at the free cash flow of both companies in 2020, it paints a completely different picture than their PE ratio. As you can see here in 2020, the free cash flow for Canadian Solar was negative $455 million, which means Canadian Solar had a net outflow of cash when not accounting for depreciation and amortization. Whereas if you look at Brookfield Renewable free cash flow, it not only had a positive cash flow, but its free cash flow in 2020 was whooping $850 million. The huge discrepancy between the net income versus free cash flow for the two companies kind of makes sense. If you recall from the beginning of the video that the total value of assets under operation of Brookfield Renewable was around $60 billion, compared to only $3 billion for Canadian Solar. So obviously the depreciation value on Brookfield asset will be much higher, which makes its net income look worse than what it actually is. So all this discussion around free cash flow conveniently lead us to our next section where we can talk about Brookfield Renewable's dividend, which is a major plus for investing in Brookfield Renewable over Canadian Solar, as obviously Canadian Solar does not pay out any dividend, while Brookfield Renewable pays a dividend of 3.63% or $1.22 per share. Again, this is thanks to the free cash flow of Brookfield Renewable as it generates enough pay cash to pay its investor, while Canadian Solar is net cash flow negative so it can't really pay out any dividends. Fundamentally, both these companies look pretty decent so far, with Brookfield having a slight advantage due to its dividends. However, we can't just look at the positives of a company, and we should also attempt to explore risk associated with the company as well. For Brookfield Renewable, its most appealing factor of giving out dividend is also a risk factor for the company. This is because dividend payout puts additional pressure on the company to maintain its cash flow to a level where it can meet its dividend obligations. And the operating payout ratio of 0.71 for Brookfield Renewable is not ideal, to be honest, especially when compared to the industry standard of 0.51, which is considered more sustainable. This is because it is better to save some cash for the growth of the company rather than just giving it out all to investors. However, personally, I don't think this is such a major area of concern, as Brookfield has stable cash flow and has been paying out dividend without any issues since 2013. Moreover, Brookfield complements a steady cash flow with a rock-solid financial profile. It has a strong investment-grade credit rating and a lot of available liquidity. That gives it additional financial flexibility to support its dividend and expand its portfolio. On the other hand, as far as the Canadian solar business is concerned, its biggest issue is its low profit margins. If you recall from the beginning of the video, the majority of the Canadian solar business comprises of producing solar cells, modules, and other solar-related products. Unfortunately, the competition in producing cells is so intense that the profit margins are razor thin. In fact, the latest quarter of Q3, the profit margin for Canadian solar was only 1.59%. That means that Canadian Solar only makes $1.59 in profit for every $100 in revenue. This means that the company really have no room for error and demand perfect execution to even earn that $1.59. One way to deal with this issue for Canadian Solar is to grow its higher margin division of global energy, which is involved with more profitable and higher cash flow business of energy storage and solar power plant operations. And Canadian Solar does seem to be making effort towards that goal as they're expecting to grow their battery storage business by 70% by 2022. So now all we can do is wait and see how well they execute this plan and its impact on bottom line and profitability. The past and current performances of the companies are one thing, but we also have to look at their future projections as well, and more importantly, the potential of both companies, which is what separates average investors from great investors. In terms of growth outlook for Canadian Solar, they're looking to grow their solar manufacturing business to achieve 311 gigawatt of solar cell installation by 2030, up from the current capacity of 150 gigawatts, representing a compound annual growth rate of 8%. However, even more important for investors looking to invest in this business is the energy storage side of business, which, as discussed before, is not only more profitable but also projected to grow at a much higher compound annual growth rate of 35%, reaching the total storage capacity of 194 gigawatts in 2030, up from the current capacity of only 28 gigawatts. So, if the management is able to execute this growth target while also improving on their profit margin, then Canadian Solar is a great business for the future to invest in. As far as Brookfield Renewable is concerned, their future is also looking pretty bright. As of now, they're producing almost $1 billion worth of cash flow with only 20 gigawatts of operating power capacity. And if we look forward, we can see they have 31 gigawatts of renewable energy projects in the pipeline, which will more than double their power capacity from 20 gigawatts to 51 gigawatts. That should also increase their cash flow, establishing them as a giant in this renewable energy sector. More specifically, they're targeting their cash flow to grow by 10% annually until 2025, meaning their cash flow in 2025 would approximately be $1.5 billion. This will also provide greater flexibility for the company to invest and grow while also providing a boost to shareholders' dividends. In fact, the company is targeting 5% to 9% dividend growth annually. So, as an investor, you will get to reap the reward of both organic growth in the valuation of the company as well as the dividend growth. Definitely a win-win situation. As you may have noticed, I have largely spoken positively about both businesses, and this is no coincidence as both companies are very well run and have a huge growth potential driven by the massive disruptive growth of the renewable energy sector itself. However, that being said, both companies have their own strengths and weaknesses, which makes one a better investment than the other. As far as their valuation is concerned, there is no argument that Canadian Solar is trading at a much cheaper valuation compared to Brookfield Renewables, even after considering the free cash flow of Brookfield Renewables. This means in the short term, there is a possibility of greater dip in the stock price of Brookfield Renewable due to its relatively high valuation compared to Canadian Solar. However, when looking from the long-term perspective, I have no doubt in my mind that Brookfield Renewable is a superior stock than Canadian Solar. I mean, as an investor, a company with $1 billion of free cash flow cannot be overlooked, and when you consider the future growth and pipeline projects of additional 31 gigawatts, combined with the world where we are aggressively trying to transition from coal and fossil fuel power to renewable energy power, the company is almost a no-brainer to invest in. And above all, the company also offers 3.36% of dividend, giving you a cushion in this highly inflation-driven market. And last but not least, the company is also planning on increasing the dividends annually by 5 to 9%, which makes Brookfield Renewable even a better company to invest in. I mean, don't get me wrong, Canadian Solar is also a great business, but they're still dominated by the photovoltaic manufacturing division, which has a very low profit margin. I will have to wait and watch if they can expand their battery storage business and improve on their profit margins before I can invest more of my money. So with Canadian Solar, I'm being a little more cautious right now. So that pretty much concludes the video, and I hope you enjoyed and found some value in my video to help you make your own sound investing decision. Please don't forget to like and subscribe to this channel and leave a comment on this video. Good luck with your investing. Merry Christmas. Peace out. I'll see you in my next video.